look at.
So is it just Palantir and then indexes for you?
Palantir, I have a little bit of AMD. I have Abcellera, which was another company that I've been, DCing into also. One of the things
not many liking Abcellera.
Huh?
I mean, we are among the few people that actually know Abcellera.
Yeah, let's talk about it. Let's talk about Abcellera.
So here's the thing about Abcellera and this is once again goes right back into investing mistakes that a person can make. I had a significant portion in Abcellera, and then I was like, okay, you know what? I know this company's really good. It's doing its thing. But then I got caught up in looking at the timelines when they would be able to be to make significantly more progress in terms of their profitability. Because the thing is, right now, a lot of their revenues are coming in just from COVID and some of the research funds that they have. And when the share started to drop, I ended up like, oh my God, what am I going to do? And I sold some of it, right? Now, if I had just gone and did my Palantir like DCA into Abcellera, I would be in a much better position, because what happened is Abcellera went down all the way to like $6 and now is back to 11. My average before all of that was around $15, right? So had I just kept DCAing in, I wouldn't have sold anything. And I actually would have been a net positive right now in a net plus instead of taking that loss, right? So I believe in the company. I believe in the leadership of it. I know the technology, but my investing style, I shifted it, and that's why I wasn't successful in it. But I do still have I do have a holding in Abcellera also. For those of you who don't know,
Oh, sorry.
No, I was saying, for those you don't know, Abcellera is a biotech company who pretty much invests in antibody research. But the way that their business model is structured is not like a traditional biotech. In that traditional biotechs, they usually have one product, they focus on that one product and take it all the way to commercialization. And then if it makes it to commercialization, it's 100x return. If it doesn't, it ends up going out of business. And what happens is there's about 90% of all pharma companies, biotech companies, they go out of business. So instead, what Abcellera does is partner with companies to do the early research, and they're good at doing that early research and then having royalty-based contracts with them saying, look, here's the product. We've done all the early research for it. You take it to clinical trials, you take it to commercialization, and we get a portion of the revenue that you guys eventually generate.
Well, also they have their proprietary software that they've created that helps discover the combinations of the antibodies. And so they've been proven to take what takes 10 years to get a drug identified, to try to take it through clinicals. They've been able to do that within months. Arnie, I know that you also like the company. Love to hear your feedback on it, and we can even maybe talk about some of these financials. I don't have them listed here. I haven't gotten that far yet.
I got interested in the company because it was listed in a very similar period of Palantir, and since Thiel was involved, let's get a look inside it. I realize biotech is clearly not my sector, but I understand that the business structure, I'm obsessed with the business structure, is probably one of the most powerful out there. Because once they succeed in getting an antibody, they get the royalties from this antibody without being committed to sell it, because the commercial side is due to the commercial partner. Let's say they developed this antibody with Eli Lilly. Eli Lilly needed to manufacture it at scale, commercialize it, while Abcellera quietly got the 15% royalties, so 100% free cash flow for that, and will take for the next 10 years these free cash flows. So the more antibodies then they discover, the more they create a portfolio that makes the company stronger and keep benefiting from this free cash flow without additional effort to generate them. The risk is the platform always on top of the edge to provide the best discovery tool so that a company is incentivized to go to Abcellera, so as a third party, to outsource the discovery process, which if I make it internally could be very costly. If Abcellera can allow the companies to make the discovery faster and cheaper, it is a no-brainer for the company to outsource it. But the more Abcellera does it, the better its AI platform to discover these antibodies become better. So the higher they increase the probability of getting new antibodies and creates a loop. It reminds me of TSMC by providing the manufacturing for Apple, AMD, NVIDIA. They are forced to stay on top of the edge. And by doing that, they create a loop. Intel right now is out of the loop, trying to get into. But clearly, when you centralize the R&D on solving a specific problem, and you can do it at scale, receiving new inputs, you become faster and faster. But it's a flywheel. Like Palantir, the flywheel takes time, and the time is what I underestimated with Abcellera. I made some in-out, but overall now I'm out because I realized it takes much more time than I expected. So I expected everything went super fast, like with a COVID antibody. Because as COVID spread, Abcellera was the first to be called to provide an antibody. So like Palantir was called for the platform for the vaccine distribution, Abcellera was the first to be called to the antibody discovery. So that is already a clear sign that it is a good player. It was also supported by DARPA. So the skill is there. But in terms of business, that was a unique case because the normal process can take just 2-3 years before getting to the clinical side, which takes other years to get approved. So my idea on Abcellera right now is I keep following the company like with a light mind. When they make the results, I follow it and see how they develop. But for me, the crucial point is when they will be faster. And the answer is probably once the GMP manufacturing plant will be ready, which is in around 2024. This facility basically is like providing the instruction code for generating the antibody then at scale. Because right now, Abcellera is focused only on the discovery, but this process of, okay, how can I replicate this process and make it in a safe way and replicable at scale? This is the component we're trying to build internally, which should help increasing the time by a lot. Until
yes, they're starting to create their, I believe they have a process already. They're starting to create their own antibody drugs. They have a piece of their business that they try to do that as well. And then they, of course, they do the discovery piece. But to your point with the GMP factory coming in, they'll be able to do a lot more at scale to create their own pieces and then sell it.
What I understood with these platform businesses is that the time is the most crucial variable, because if you shrink time, you increase the flywheel. And it's all about the flywheel. The faster...
Well, here's the shrinking of time, right? Like 29 years, it took the first 50 antibodies to get approved. Now we're at 6 years. But to your point, this is why I haven't like bolstered on more on my position, because I have 4% of my portfolio in this, but it does take a long time to do clinical trials and everything. So, you know, what is the expected turnaround on these?
And there's also counterparty risk too, right? So an example is just because Abcellera does the research, they spend all the time doing the research and giving that final product to the, you know, manufacturer. If the manufacturer doesn't see the value in it, even if it's the best thing that's ever happened, it will never become a marketable product. So an example is if you discover something, Abcellera says, hey, this is a good product, and the other side just says, well, you know what, that's not in our time frame right now. We don't want to invest in the commercialization portion. Even though Abcellera would have gotten a lot of revenue had it been a commercial success, the business was not willing to go further So an example is Eli Lilly, I believe, was one of the worst partners that Palantir could have chosen because of a lot of the slow
Palantir?
walking that, huh?
In Abcellera? You said Palantir.
Yeah. I'm sorry. Abcellera did with Eli Lilly, because Eli Lilly slow walked a lot of the therapeutics that were out there. And at one point, even like took some off the market, put them back on. Like if it was a better company that I think Abcellera would have partnered with, they would have had significantly more revenue come through the door, because there would have been a lot more marketing that company did and commercialized the antibody product. Right now, bebtelovimab literally was ready to go from Abcellera in the summer of 2021. And when the pandemic was still like out there, like really badly. And Eli Lilly, for some reason, I don't know if you remember this, Dom, was just slow walking the entire process because there was so much bamlanivimab that they still had that they were trying to unload before they were putting the newer product that was better, right? So because of that business use case, Lilly was slow walking a lot of things, which meant that Abcellera was not getting that revenue. So right now, I think what happens is there is a significant portion of counterparty risk when it comes to it. Like right now, if TSMC develops a great product, gets everything, and then these other companies are like, well, it's a good product, but we don't want to take it any further. Right now, all the stuff that you developed is just going to sit on a shelf, right? So I think right now counterparty risk is a big problem. The GMP manufacturing, what that'll do is just shorten the time frame again, right, and that'll help in the future. But I think Abcellera has a bright future. But I would say if you're looking for instant returns over the next 5 years, you're not going to get it. This is like a huge long-term play that is
and I think that's what I've learned with healthcare, with biotech in general, and individualized, personalized medicine. I have admittedly made lots of mistakes in the last 24 months with investing in that space of thinking things would move a lot faster than they would, and understanding, it's great if you're willing to hold on to a company for 10, 20 years. The problem is you also have to make sure that they have the cash flows and the no debt and the business model that will get them there so they can find these discoveries, right? So I'll give you an example. I invested a decent amount in SEMA4, and that was a SPAC that came public in 2020. And they had, petabytes of data of personalized medicine and drug discovery. And they have 4 different healthcare systems they're working with. But going through the cash burn and everything else that they've had to deal with in building their business model, and sometimes investing in companies that have great scientists and great engineers, but not necessarily the business aspect of running the company, can really burn you or burn shareholders from that perspective. And that's definitely what I've seen in several companies.
That was also the risk with Palantir if the dilution was not counterbalanced by now strong free cash flow, because when they listed, there were actually negative free cash flow or slightly positive, now I don't remember, but right now the free cash flow generation is there. And I think this is the most important thing, especially during downturns. I understood that the best situations are like what we said, the business is thriving, and we have evidence that Palantir is thriving from the contracts, and there is a clear growth trajectory and benefits from these external things happening. But the price got crushed. When you have these two combinations, you know that if a business keeps doing better and better, and the valuation becomes stretched, then time goes in your favor, because the multiple gets so compressed that at a certain level, people will see it. Okay, imagine Palantir trading at a price to free cash flow of 10. I mean, you don't need to be a genius to understand that is clearly cheap if the growth trajectory is untouched.
So do you look at price to free cash flow then, than opposed to price to sales and earnings?
Yes, that is what as soon as they stabilized the margins, I focused on that. And I say my simple rule of thought is I don't do the DCFs. I made a lot of DCFs when I was an analyst, and probably that is why I dislike them so much, because the DCFs make you rely too much on the assumptions rather than focusing on, okay, what I'm really buying right now. And what I was really buying back then at 20, it was a company that was growing some 30%, but at a price to cash flow of 50 or more. It's like, yeah, is okay, probably is deserved because Palantir is Palantir, but it's not a price I'm confident at buying. But at 10, and then when I added heavily at 7, at a price to cash flow of 25, compared with a growth of 30%, it's like having a peg minus than 1. But it's like the peg, but with free cash flow. Even considering a dilution of heavy dilution of 10%, I'm not overpaying. That is why I'm at this price, I'm confident buying. With Abcellera, it's different because
hold on. You're hitting on a lot of great stuff. I don't want our audience to miss it.
Maybe I went too fast, sorry.
Yeah, no, you're fine. You're hitting on a lot of meaningful stuff for new and experienced for investors. So when you talk about, I want to just, we'll come back to Abcellera here, but going back to the DCF comment about the discounted cash flows, I've been having the same kind of feelings lately, listening to a lot of different seasoned investors, books and podcasts, and everyone has their different opinions on DCFs, but can we agree, or do you guys feel that DCFs rely too much on long-term assumptions, and that you really shouldn't do a DCF other than maybe the first 2 years if you're going to use that, because there's so much more unknown? That's why I like ROIC and free cash flow and that kind of analysis, looking at the business from a health and sustainability perspective, opposed to a DCF. What do you say, Kris? And then I'd love to hear Arnie's thoughts too.
I think DCF works, but DCF works depending on what kind of industry that you're talking about, right? If you're talking about, like, let's say an industry that's very mature, that you can see fixed growth, fixed revenue, that you can probably easily do, right? But if you're looking at completely new industries where things can change at the drop of a hat, then no, DCF models don't work. So I think you have to apply it industry specific. So when it comes to growth, I wouldn't use DCF, but if you're looking at a very mature value-based company like Walmart or Costco and stuff like that, then yeah, it totally works, So I think, like I said, you have to apply it based on the industry that you're targeting.
I like that. DCF with growth, maybe not the best aspect. What do you think, Arnie?
I think there is an interesting point in the value investing community. Buffett is always saying, you need to do a DCF to understand the future value of the free cash flows. And Munger, I've never seen Buffett doing a DCF. And it's like, how? The reality, this is my speculation, is that it's extremely crucial you understand the DCFs, because that is how money is generated to you as a shareholder. But calculating the DCF is not that crucial, because if you buy a company that is extremely stable, or the metrics are kind of stable, let's see, Palantir has a 30% growth, and we can expect reasonably that 30% growth is going here to stay. I can tell you that at a price to cash flow of 20 or 15, even with a conservative free cash flow, you'll get a good valuation. But this way, I focus on, okay, how the company is really growing. Are there good reasons for Palantir to keep growing at 30%? In my opinion, there are, for multiple reasons.
So that's a good point. Let's pause there. Everyone's saying they're going to grow 30% annually. So you have to ask yourself, do they have enough optionality? Do they have enough target TAM?
Exactly.
Audience?
We should focus on that rather than doing models, because the risk with models is that you put too much on what you would like to see on those models. The only smart way to use DCFs is testing the price. So an inverse DCF, start from the price and recalculate everything and say, okay, at this current price, what are the growth implications, the growth implied to the price to make it reasonable. If you see that Palantir trades at 40, it means that the growth implied in that price are probably something like 50, 50, 50, 50, 50 with a low WACC. And the WACC is another monster because
weighted
it's probably
average cost of capital. That's what WACC is. Just so our viewers understand what WACC is.
Yeah, sorry.
No worries.
Because the problem with Wacc is that I call it the magic number you put to get the valuation you want. The idea is that Wacc is considered to be low for those companies that have a very resilient business. Let's say Coca-Cola has a very low Wacc, which means some 7%, 6-7% discount rate. While a company like Palantir can have a WACC of 9-10% because it's considered risky. The WACC calculation is done using the return on equity, which is calculated using the beta. And the beta basically says how volatile is the stock. So here comes the paradox. You can have a stock that is incredibly volatile, like Palantir, which have a very, very, very high beta. So the market moves plus 2%, Palantir goes plus 5%. But on the other hand, when the market goes down, let's say minus 5%, Palantir likely goes minus 7, minus 10. This just because it belongs to the tech sector, and the tech sector, the growth tech sector, has a high beta. So it comes to have these asymmetries that have no sense if you look at it as a business owner perspective, because the real risk of Palantir is not dependent on how the price move, but on business reasons. So if you have the business that is incredibly stable, 50% revenues from the government with recurring revenues, printing free cash flow, I would say the business structure of Palantir is stable and safe. Then there are execution risk and so on, but the business structure is very strong. But the price is extremely volatile. There could be many opportunities to buy the company at a good price because it's perceived as risky, when in reality the intrinsic risk is much lower. And the worst with the WACC is that if you have a company like Coca-Cola having a lot of debt, it has a lower WACC just because it has debt, because debt costs like 2-3%, and the weighted average cost of capital includes the cost of equity and the cost of debt. If you have some debt, that reduces your weighted average of cost of capital.
So you actually get a benefit of a low WACC for having debt, whereas Palantir has a clean balance sheet, zero debt.
And that penalizes the WACC. So if you have the same company with debt or no debt, the company having debt is considered more valuable because it has the benefit of the tax shield coming from the debt. But in reality, we know that having debt is not less riskier.
Yeah.
So there is
especially with rising interest rates.
Especially
with rising interest rates. Yeah.
Exactly. So this is why I go very against what I've been taught at business school, because you study these things and you think that all of this makes sense. But when you look really through these things from a business owner perspective, you realize, what the hell did I study?
You're getting me to think that way, because I've just been going through some of these different books and going through these topics and theories, looking at DCFs and everything else. And exactly what you said makes perfect sense. It's almost like you can overthink or over calculate these stocks and where they're going to be, when really the reality is there's so much that's unpredictable. The question is, how well do you know the business to have a good idea of where it's going to go and kind of make those assumptions? Kris, I know you're about to say something. What do you think there?
The person, and this goes, there's one person that is retired right now. That's one of my friends that worked at a hospital with me. And his entire investing strategy, which I thought was stupid and ridiculous when he told me, and he told me a long time ago when I first started working there. And I was telling him about, oh, you know, you should look at this, you should look at cash flows. And he says to me, Chris, I don't do that. I said, so what do you do? He's like, well, if it's a product that I use and I like and I can't live without it, I just buy some stock in it. And that's it. And I'm like, what? What do you mean? Like, dude, that's not, you know, I don't think that works. He's like, okay, try it. You'll see. You'll call me in 10 years. He bought an iPhone. He took the equivalent amount and bought Apple shares. He was using Facebook all the time, bought some Facebook shares. You know, everything that he's like, every day I use Microsoft Excel. Why don't I buy some Microsoft shares? Everything that he saw that came around, he bought CRM before everyone bought CRM because he was in at my hospital in that division. So right now he was like, yeah, man, I see this company. Yeah, I'm gonna buy some Salesforce. And I was like, what the hell is a Salesforce? I'm telling you, this guy, his investing strategy was not based on numbers, but what he's using. He bought Chipotle. He's like, man, I really like this Chipotle burrito bowl, and he bought Chipotle. There isn't a single stock that this dude bought that he hasn't like exponentially. He bought Tesla. Why? Because
is this guy Peter Lynch or Peter Lynch's son?
I don't know. Yeah, literally, it was this guy bought Tesla in 2016 because he took a ride in someone's Tesla and he really liked it. I was like, okay. He told me about it, and I was like, man, this guy coming here telling me about what I use, I buy, and hey, guess what? It works. You know.
No, I like that. I mean, that's area of expertise and use and experience, and I've heard of people doing it that way. And of course,
he made money on Zoom. He was like the first one. It's like he was telling me about Zoom when we first went into pandemic because we started shifting over into Zoom, starting to use it. He's like, man, I really like this company. Okay, bought some Zoom. I mean, he's down in it a little bit now, but when he bought it, he did exceptionally well, you know. And he never sells.
Actually, to that point, I did on Zoom because we use it religiously at VMware years ago, and I got in at like $80, and I was like, you know, I just liked it. I was like, this is a way better product. And then it went all the way up to 400. Now, granted, I didn't sell,